I'm Eddie Cannell.
And I'm Tom Cannell.
Welcome, everyone. This is the Mortgage Brothers podcast show, and today is Wednesday. What is it?
August 17th.
17th.
And this is your interest rate update.
If you're new to the channel, be sure to subscribe, comment, and like. We do this Monday through Friday, and remember, this is for informational purposes only. This is not financial advice.
That's right, folks. We are not financial experts, and I even forgot what we were supposed to say.
No, we're not financial advisors. We're not your financial advisor.
That's right.
We're mortgage brokers.
That's right. I was going to say one day we may be, but no, we'll never become financial advisors.
I don't think so. Okay, loan programs, 30-year fixed interest rates at 4.99. The 15-year fix at 4.375.
The 30-year FHA 4.5 and the 30-year VA 4.5. So up about an eighth across the board from yesterday.
Interest rates have gone up. Now, these quotes come with no extra fees, no points, no buy-down costs based off of these loan assumptions for conventional, FHA, and VA.
That's right. And these, as we always say, these are very typical, standard, scenarios. It's not like this is 1 out of 1,000, just so we can show you a better price. No, this is the real deal. So, 80%, 85% of our loans fit within these categories.
Yep. And we do believe about 90% of banks out there, especially if you're out there searching for a home, for home purchases, if a bank is going to be giving you a 4.99% interest rate, they're going to be charging you $4,000 to $5,000, especially in purchases.
Right.
Okay.
Yep.
So, I would say a lot of banks, if they're not going to charge you any points, it's probably going to be like 5.25 to 5.5.
Yeah. Yep, exactly. Talking to a borrower just this morning about other financing needs, that he has. And it was like, well, we know the financing is going to be 8 or 9%.
Wow.
Again, this was automobile. This is credit card. They need to, improve this or do that. I mean, look at this.
Yeah.
This is the cheapest money ever out there.
Yeah.
So, and we do need to do a podcast on that. That when we get these interest rate updates, you can look at it from an expense standpoint, like, oh, what is my home going to cost? Or you can look at it from an opportunity perspective. The home is only going to cost this. Interest rates and inflation are super high, but look at this. You're still borrowing money very, very affordably.
Yes, everyone's, I think we're starting to get used to the little bit higher rates now. People were used to the maybe rates in the 2s and the 3s.
Which was not real.
Yeah.
It should have never been real.
And I think those opportunities will come again, but they're not going to come anytime really soon. This is still a great opportunity to buy, and we can always refinance into lower rates.
That's right.
And I wanted to show you this here. Where does the Wall Street believe the Fed rate will go? What's happening is the Fed does not meet once a month. I think they meet about 9 times a year. So they're skipping August. It's probably on recess. Like they just are not meeting.
Yeah, they got to go on summer vacation too,
Right. And here's interesting too. So in July, there was an 81% chance that the Fed would raise the rate 0.75%, and it did. It did raise the rate 0.75%. Where are all these stats coming from? They're coming from the Chicago Mercantile Exchange. These are where the traders, the futures traders, are basically playing bets.
That's right. They're waking up every day, and instead of like figuring out what stock is pricing, they're going to see what the chances are the Feds are going to be moving, and so it's constantly moving. Tomorrow, it's a daily basis it'll change.
Or
weekly?
Even in the middle of the day, it'll change.
Mm-hmm. So again, this 50% and 50% chance, just like the one above it, that was changing daily. So this is what they're forecasting today. And we had said at one point, it's like forecasting the weather. We think it's going to have a 50% chance of it, having a 6-inch snowstorm, in September 21st. So make sure you buy, big boots. Well, things can change. All of a sudden, the forecasters can say, looks like the sun's going to be coming out, folks.
Right.
So that's when people run and trade in their snow boots for swimsuits. So this is simply them trying to project what it will be in the future.
Yeah, so overall, what we see is the 50% chance on either side in about 1 month. 1 month they're meeting. Now, look at the next meeting after September 21st. It's November 2nd, right before the elections. I think the primaries is like November 4th. This will be very interesting. what they show right before the elections. But we wanted to show you this. We'll keep you guys posted on that, and also show you this is the Fed funds rate. This is the chart since 1955. And I wanted to make sure can be really confusing. Like, what is the Fed funds rate? It actually is not so important to know what it is, but if you do want to know, it is the interest rate at which commercial banks lend their excess reserves to each other. So imagine that Wells Fargo has a bunch of extra reserves, like just cash reserves. If they want to lend it to Chase Bank, they would lend it at 2.5% today.
Mm-hmm.
And they borrow from each other that way, like
right.
over, and it's called the overnight Fed rate.
Yep, and they're being told what that rate is. It's not like Wells just wakes up and says, "Hey, let's go ahead and charge 2.5."
Yeah.
No, that is how the Feds are controlling the market. Is they are forcing banks to borrow or to lend excess money at X amount.
Yeah,
and if times get really tough, they're going to force them to lend them at Y amount.
Yes, and there's another rate called the discount rate, and that's the interest rate that banks, if they want to borrow from the Treasury Department, that they can borrow, but it's a higher interest rate. So this rate is lower. It's better for banks to borrow from each other. Anyway, I wanted to show you that chart. See, at one point there in the early 80s, it was, but boy, almost 19%.
Yeah.
And what you can see here is we're at 2.5, and they might see my little green markers right there. That's where the Fed wants to go. And a lot of economic scholars believe they really can't go this high.
Mm-hmm.
They don't believe that they will. These are the future meetings. And remember, we're going to continue to hear about higher rates, but it's already baked into the mortgage rates.
Right.
So all these little adjustments have already been kind of traded and accounted for.
Right. And then last little point, it's not that the Feds are making any money off of these rates. They're simply doing this in order to suppress or to push up the economy. So even though they're wanting it to go up, it's not like they're gaining anything by getting more in their wallet. They're just simply saying we've got to raise rates in order to push inflation down.
Yeah, they're just controlling that rate that the banks charge each other. And then it's amazing how much that does.
Yeah.
Because with what they are borrowing that money from, because what they do is those banks turn around and lend it to the public, to other companies as well.
Mm-hmm.
If Tesla wants to go and raise money or borrow money, they have to borrow it from the bank, and it'll be a higher rate than 2.5%. But the point is, that's how the banks make their money.
Yep.
Okay, everybody, we're gonna be back tomorrow. Have a good day.
All right, thanks, folks.
Thank you, everyone, for watching our show today. If you have questions, be sure to email us at rates@azmortgagebrothers.com, and be sure to take a look at all of our other videos on our channel.